What is good, trading family? No guests today, just two mics and a full map. Flat is a spring, not a lie. Friday closed green, the SPY up 0.4, small caps up 0.76. Nobody believes it. Flat board, the VIX, the volatility index, up 5%.
Quick note before we go further. Nothing we say is financial advice. Do your own research. Overnight tape says the same. Nikkei down 0.74%, Hang Seng down 1.89%, Kospi down 3.12%, Shanghai down 0.59%. Europe is flat, not panicking. Dollar yen up 0.15%, dollar index up 0.18%. This is levered money off, not risk off.
That is the frame, brother. The economy is fine. Earnings are tracking 15 to 20% above early year forecasts. The leverage is what is leaving, not the profits. That frames the whole show. Canada is the most underpriced story on the board. Talks collapsed. Friday, 50% tariffs went live. Saturday, on about $20 billion in goods.
Dairy, wine, wood, ceramics. Carney says dollar for dollar retaliation lands September 8th. Steel, ag equipment, paper, electronics. The loonie is down 0.5% and equities shrugged.
That shrug is wrong. 2 months of that drip is a slow inflation tax into an affordability election. The market shrug is not just complacency. It is tariff fatigue. It has priced the first headline and ignored the compounding tail.
But this is not a single tariff. It is a 2-month drip into an election. The margin squeeze on retailers is real. Watch the Canadian dollar. It is the cleanest expression of the trade. It keeps sliding, the board is too calm, the ground beef waiver is the tell. The White House opened a 300,000 metric ton waiver on beef imports while firing tariffs at Canadian dairy.
That is the administration admitting tariffs feed food prices before they even blink.
Whitmer is saying Michigan cannot afford this. Tuesday's special election is the live political tell.
Carnies, they ask too much. Line is the soundbite for the whole dispute.
The market prices the first headline, not the 50th. No agreement before the midterms.
This runs into November, and the board is asleep at the wheel. Next landmine. Bessent, at 2 o'clock Eastern. Oil selling into it.
West Texas Intermediate crude down 2.24%. Brent down after 2 weeks of gains.
That is positioning for the reveal. The leaks are the plan.
Sanctions risk is partly priced. The danger is sell the news.
If the announcement has no teeth, the volatility spike fades.
The only thing that flips it is real teeth. A Hormuz mention, Gulf retaliation talk, anything that threatens dark flow. Countercase. Because we have missed oil risk calls before. If Bessent de-escalates and keeps the focus on the bond market, the war premium fades hard.
Remember who Bessent is fighting. The bond market on one side, Iran on the other.
And a boss who floated military options on a Friday. That presser is him trying to win 2 wars with one statement.
That is the honest read. The presser can break either way. We do not chase the first headline.
The long bond is the boss this week. Morgan Stanley's call this morning says the post-World War II regime is over. Falling yields, cheap capital, low inflation. Structurally done.
10-year at 4.70. Term premium, running 150 basis points over Fed funds. $40 trillion in debt. And Bessent says, peak deficit. The market is saying, prove it.
TD Bank's line is honest. A few $1 billion of long bond buybacks will not change momentum. Fed talk cannot talk yields down. The moment it tries, it looks like panic. The term premium moving this hard means the bond market is repricing the entire curve, not just the short end.
It is not the Fed. It is the market telling the Treasury it needs real money to fund real deficits. Gold handoff. Gold at 4,700, while Asia bleeds and the loonie slides. That is not a hedge. That is a referendum.
Money is refusing to hold paper at 4.70 with $40 trillion in the rear view.
One story, 3 expressions. The bond, the gold, and the sector tape are the same debasement sentence in 3 languages.
That sets up rotation before we even say the word.
VIX checkpoint. If it grinds higher from here, hedges are real.
If it fades lower after Bessent, the market is complacent into the rest of the week.
Earnings block is not quiet. Monday has PDD and XPEV.
Tuesday has DKS, Into, and ZM. Wednesday has Nvidia, Salesforce, CRWD, and Okta.
Thursday has BBY, DG, Marvel, Offerme, Ulta, WDay, and Gap. Nvidia is a Wednesday earnings item.
So earnings block is loaded. Move on to the data. Economic calendar. Wednesday, August 26th. Chubb Consumer Confidence Consensus 90.3 versus prior 90.8.
A miss there, says growth scare. Japan. Bank of Japan core CPI is due, prior 2.7.
Germany GDP consensus 0.2% and 0.9%.
Thursday is the main day. Core PCE price index consensus 0.2% month over month, 3.3% year over year.
Core durable goods orders consensus 0.5 versus prior 0.7. Durable goods orders also 0.5.
GDP consensus 1.5 versus prior 1.5. GDP price index consensus 6.3.
Atlanta Fed GDP now consensus 4.0. Dallas Fed PCE prior 1.40.
Watch a hot core PCE. Rate cut bets fade, yields up. Pressure on long duration and tech.
A weak Chubb consumer confidence number gives the growth scare bid to bonds.
Friday, Tokyo core CPI consensus 1.8 versus prior 1.7. Japan unemployment rate 2.5.
Hot Tokyo CPI pressures the Bank of Japan. That is, yen carry unwind risk into United States names.
Weekend has Germany unemployment rate 6.4 and Eurozone consumer confidence negative 16.3 versus negative 15.5. The order matters. Confidence first, then growth and inflation on Thursday, then Tokyo on Friday.
If confidence is weak, Thursday's hot PCE can still be bought as a one-day bond bid. That is the data gauntlet. Thursday is the real macro test.
Rotation board. Leaders. XLV Healthcare up 4.3. The energy sector. ETF Energy up 2.79. XLB Materials up 1.9.
Laggards. The tech sector technology down 3.53. XLU Utilities down 3.48. XLI Industrials down 3.36.
This is not broad risk off. This is leverage leaving the system.
Money is rotating into healthcare, energy, and materials, while tech, utilities, and industrials absorb the pain.
This is hedge fund behavior. 3-month peak to trough. Drop in gross leverage.
Artificial intelligence leverage wiped. Money parked in healthcare and gold.
Healthcare and materials leading is not a soft landing signal. It is an inflation and hard asset signal.
Utilities down with tech says the market is pricing real yields, not just a growth scare.
The debasement bid is wearing an equity costume. My TFT algo is living the same move.
Healthcare ballast names like Amgen are doing the quiet work.
Materials beating the S&P has historically led to VIX spikes toward 25, 30. We sit at 15.89.
That is the uncomfortable part. The rotation is calm until it is not.
International block. Asia is the supply and leverage story. Alibaba did the biggest secondary in Hong Kong history. $10 billion priced at 112 Hong Kong dollars and 70 cents.
It broke the deal price. Stock down 10%. Worst day since April 25.
Alibaba breaking a $10 billion secondary below issue price leaves a 3.5 times normal turnover overhang.
That overhang sits on every tech bid until it clears. Funds reduce before they reload.
SoftBank is pulling $6 billion on top. Too much paper, not enough bids.
Kospi down 3.12%. Korea is the most levered offshore retail book in Asia.
That is not just a Samsung Capital returns disappointment. That is leverage unwinding in the most levered book.
Hang Seng down 1.89. Nikkei down 0.74. Shanghai down 0.59.
Japan is not the problem this morning. Korea and Hong Kong are the leverage overhangs. Europe is flat. DAX down 0.02, FTSE up 0.11, Euro Stoxx 50 down 0.09.
Dollar yen up 0.15, dollar index up 0.18. Yen carry unwind is not the main risk this morning.
And the quiet story. India lifted the wheat export ban. Supply is coming back into a war-hit grain market.
That is a disinflationary shock into a week of inflation headlines. Grain will feel it.
It connects to United States names through risk appetite and input costs. This is flat to softer futures, not a crash. Portfolio hot news. Nvidia is not just a semiconductor company anymore.
It has become the artificial intelligence trade's lender of last resort.
Funding customers, writing checks its own ecosystem may not be able to write. That is a central bank with a GPU.
It is funding poolside, maybe sniffing around perplexity. That is not a chip story, that is a backstop story.
Drivers, 6-day slide, 5 straight prints, where it closed red, even when the numbers were great.
Reports of 15% price hikes on memory pass-through. Options imply a 4.5% move.
Hyperscalers are building custom silicon. Amazon, Microsoft, Google all have their own chips now.
Bull case. Nvidia remains the only name funding the artificial intelligence ecosystem. Pricing power intact, demand still strong.
Bear case. If Nvidia has to keep funding its own customers, the margin story gets complicated even when revenue stays clean.
The artificial intelligence trade needs a trend break. This is a leverage unwind, not an earnings growth problem.
The question is whether Nvidia can fund the ecosystem without turning its balance sheet into a venture fund.
If it cannot, the margin structure shifts even if the top line never breaks.
This is not about a beat. It is whether the artificial intelligence trade stands on its own without Nvidia holding the bag.
Second order effects. Custom silicon reduces Nvidia's lock on hyperscaler spend. The central bank role means margin mix deteriorates during stress. Artificial intelligence leverage unwinds hit semis first, then broader tech.
Book touches. Semis are dragging. My gut call account is not new. Long semis into this.
My wave trader algo is holding Marvel and Nano Nuclear into the events with wide stops. It does not have my loss history, so it can take the risk.
My paper account has the energy sector ETF, riding with stop discipline. Energy is the ballast, not the bet.
Cash is a position into the gauntlet. My gut book stays in cash until the week's landmines are behind us.
Here is what we are watching tomorrow and the rest of the week.
Tomorrow, the Michigan special election is the political tell before the data avalanche. Wednesday, Chubb consumer confidence. Consensus 90.3 versus prior 90.8. A miss says growth scare.
Thursday is the real macro test. Core, PCE 0.2, month over month, 3.3 year over year, GDP 1.5.
Friday, Tokyo Core, CPI 1.8, Japan unemployment 2.5. That is the yen carry input.
Book level. My paper account. The energy sector ETF is on with stop discipline. No hard levels to flash into the tape.
Thesis is not broken. The stop is the rule that makes the position honest.
Tape checkpoints. VIX sits at 15.89. Grind higher means hedges are real. Fade from here means complacency.
The prep callout is a plan, not a mandate. The tape gets the final word.
That is the show. Charts are clean, cash is loaded, and the tape will tell us everything. We are out.